coffee.
Finally got to catch up with people. I'm super charged from people, man. Miss talking to people, seeing people.
Oh my gosh, it was like brushing off the cobwebs, man.
Our conference was a big hit. So for those of you that attended, thank you very much. We had a blast. It was awesome seeing you all. And for those of you that didn't attend, I'm disappointed, and I hope you will attend the event next time.
No, we got caught up with a lot of old friends, met some new ones. I think the feedback that everybody was giving us was thank you for doing an in-person event, because I think everybody's getting a little bit of a Zoom fatigue was the saying going around, right? So for those that are interested in the next one, follow us on our MFIN page or on the Disrupt Equity page. We'll be announcing it, but just so everybody knows, July in Florida will be the next time we're going to do one.
Yeah.
So we're going to double down. Now that we got the first one out the gate again, we're going to keep doing this. So be on the lookout for
Florida in July. So keep that open, people. Do not do anything.
So we'll be after July 4th, probably before the end of the month. So one of those 2 weekends.
Bring your Disney ears and your bathing suits, because
one of those two. I don't know. It's going to be either Tampa or
Don't wear your bathing
Orlando.
suit to Disney, though.
Yeah, it might be Tampa or Orlando. We're just trying to see what's the most cost-effective.
Miami. Yeah, see, even Shannon's
like, of course you want to go to Miami,
no,
right?
It's going to be Orlando or Miami. That's what.
Yeah. We were telling people Tampa.
You were telling people Tampa. I was telling people Miami.
Why were you saying? Whatever. All right. Anyway, it's going to be Florida. It's going to be fun. It's going to be great. It'll be warm. We'll be close to the water, hopefully. That was why I wanted to do Tampa. But anyway, besides that, what are we talking about today, man? Real estate?
How to pick your real estate market for multifamily investment.
Ooh, okay. So this is one of the most important things. So 3 things that you want to look for, right? Who's the team that's putting the deal together? What's the property, right? What's the vintage, and where's it located at, right? So these are the 3 core things that as a passive investor you need to be looking at, right? So how do you pick, and we've gone through some of the other ones, how to pick a syndicator and some things to ask, right? Today we're only going to focus on the market, right? And how do you pick those as a syndicator, or some of this could even be as a passive investor, right? If you're trying to vet deals, doing due diligence on a deal that you're looking at, some things to maybe ask the syndicator that that you want to know, right? So before you're getting into investments, right, you need to understand the market and how things are kind of affecting that, from population to job growth to median income in the area to crime statistics to what are the school districts like. Right? And I think even as a passive investor, you need to have your box defined. We have talked about this several times on this show, right? And as a syndicator, you definitely need to have your box defined, because you're going to need to establish those relationships with the brokers, right? So you can't just be throwing random offers out all over the United States. It just doesn't work like that, right? So pick maybe, starting off, I'd say 3 to 5 to really focus on, and get to know those brokers, right? Okay. But some of the metrics that we talk about that you need to analyze are the basic stuff, right? And if you don't know these things in your market, then you're probably going to have a problem.
And maybe one thing to add, right? The metrics, what are the point of the metrics, right? All these things you're doing, you are looking to do what?
You're trying to determine ultimately.
What are you looking to reduce? This is how Ben can read my mind.
Risk. You're trying to reduce risk. You're also trying to determine the demand for rental product, right? Because more population growth, more job growth, a great school district, right? That all is going to drive demand for rents, right? So because we know people that, or we've heard of residents that will, come to some of our properties just because they're in good school districts.
Absolutely.
Right? So you have to understand that that's a driver too for certain people.
And
right?
it's not this, you're doing this to reduce risk and make your life easier and hopefully perform on what you're trying to do. Right, it's not to say you can't make money without all these things or any of these things, right? You can make money, in the moon if you can sell to aliens. That is not a bad analogy. I've been on an analogy high. I finally botched it. All right.
Yeah, you botched that one.
But it doesn't matter where you are. You can make money in certain things, but ultimately you're looking for making life easy, right? Detroit people still make money, right? You can still be in a war zone and still make money, right? And so, but you're constantly looking to be a smart investor, reduce risk, right?
Yep.
So.
No, absolutely, right? This is not an all-inclusive, every box needs to be checked or don't look at it, right? It's just these are some of the things that we look at, so we want to share that with, people that are tuning in, right? These are the most important things. So once again, job, population growth, median income. We talk about absorption rates on our that's important too, somewhat, right? To see if there's going to be an oversupply, right? Which will, put stress on rents. But I'd also say crime and school districts are just as important too, right? So check those out. And a lot of this stuff is readily available, right? What is it, city-data.com? So you don't necessarily need to have a CoStar, access like we do, which costs us a fortune. But you can also ask mortgage brokers, right? They're going to have access to that, right?
Yep.
Sometimes your insurance guy is going to have access to that, right? So ask those folks, and they'll be able to provide those reports to you, right? Which is going to have a lot of this data, right? So kind of moving along, right? Some other things to kind of understand in the market, right, are where are cap rates, where are prices per door, right? You're going to need to understand that. What are the taxes in the submarket, and how do you handle those? How do you underwrite to those? Like one thing that was interesting to us when we started getting into Phoenix, into Arizona, which we made offers in, we do not currently own it, right? Taxes and insurance are crazy low compared to what we have to deal with here in Texas, right?
Yes.
And so that's why, at the end of the day, a Class C property is trading for 6 figures.
No, and people need to realize that, right? I think people always, including ourselves, right? Whenever you don't know enough about a market, right? You just look at price compared to here to there. Well, let's just take an extreme example, right? Let's say you have a market where you're paying $1 million in taxes a year.
Yep.
And you have another market where it's 20% of the basis, so it's actually $200,000.
Yep.
That $800,000 difference.
That's a lot.
That's a lot. Let's just say it's at an 8 cap or a 6 cap, right? Let's do it right now. Divided by 0.06, right? That is a difference of $13 million.
That's a lot
in value.
Wow.
And so it's easy to say. So if it's
and that's just a 6 cap. Some of the deals are traded at 6 cap.
It's actually like for like. So you got a $13 million price difference. It's really kind of like for like in terms of cash flow.
Yeah.
And so Atlanta is actually a good example where it's literally 40% of the cost basis, the appraised basis is what is tax. Mm-hmm. Houston is not that, unfortunately. And so even in Atlanta, right, $130,000 a unit deal may be equivalent to $100,000 deal in Houston.
Yeah.
Because of that, right?
So
something to keep in mind.
Don't dismiss. We like prices per pound just to have. That's just one metric that you can kind of put into your underwriting as another data point, right? It's not the end all be all where you think, oh, that's expensive, right? Don't ever dismiss things out of hand. I'll pay $1 million a door, right, if the rents justify it, right? So cap rates, understanding where those things are trading at, and the brokers that you're talking about, if they're candid and honest and transparent, which most of them are, they're going to tell you, hey, this is where things are trading at. It's 4.5, 5 cap for Class B or whatever, right? Prices per door, need to understand taxes like we talked about. Home values, I would say, median income as well. Economic drivers, right? And the one thing that you need to understand is it a one-trick pony town, right? Is there one industry or one factory or one thing that's driving, job growth? And what happens if that goes away, right? That's going to destroy your whole thesis, right? So you need to understand that. And I'm not saying, once again, that you can't make money in those markets. Just understand that that's a risk. And what are we trying to do?
Reduce risk.
Mitigate risk. Right? Risk mitigation is all we try to do. De-risk the deal, right? So vacancy and rents, right? Understanding where those are at. There's going to be some markets where, occupancy should be 95%. There's going to be other ones that are going to be closer to 92, right? So you need to understand where that is and how does that kind of bake into your underwriting. And then ultimately, what are the rents trading at, right? I think the one thing, the two data points that we usually look at really, really quickly is what's the rent and what's the price per pound, right? And then we can quickly kind of determine, is it even worth it for us to look at this? Because there's this, and I'm not going to give away this formula because we've talked about this sometimes, but there is a correlation between the two, right? And if you have too much of a price per pound and not enough rent, I can tell you right now, I don't even have to look at it. The deal's not going to make sense. So you need to have a good understanding of these different metrics to determine if the market is even something that looks good. And one thing I want to point out, I don't know if we had it on the next slide, but don't just look in your backyard. A lot of people get caught up in, well, I want to, look at it and kick it and all this stuff, right? So I think you need to understand that, you might be passing up on opportunities, right? We shied away from Houston for different reasons for quite some time, but now we're coming back to Houston for other reasons, right? So, but you can certainly make money and be very, very successful outside of your backyard, right? There's great property management companies out there. There's great vendors in other cities, and ultimately you might be passing out on opportunities just because you want to see the deal, right? So, what markets we like and why? All right.
Any market I can make money in.
Yeah, that's
my political answer.
That's on a high level, that's true, right? I mean, we'll buy a deal pretty much anywhere. I mean, I always kind of hate on certain markets, right? California and New York being a couple of them. But if somebody's going to give it to me at the right cost basis, I'm going to be able to make money there too, right? The problem is those places tend to be priced at a premium, as well as having some other headwinds that go against it, right? Not being landlord friendly, not being tax friendly. Two things that we really want to make sure that we're doing, and that's to add to the list of the things that you should look at when you're talking about submarkets, right? We talked about this at the conference this weekend, right? If you're in a non-landlord friendly state, you could get hosed. I mean, we're already struggling as an industry with evictions and moratoriums and delinquency and stuff like that. Do you really want to be in a submarket that's also just generally going to make it hard on you as a landlord? And I mean, eviction process in some of these places can take 6 to 12 months in the best cases.
Not the most fun.
You think anybody's evicting anybody in California? Absolutely not. Right? So some of the markets that we like, right? And this is not an all-inclusive list, but obviously we are here in Houston. We like Houston. We like Central Texas. What does Central Texas mean? That means San Antonio, that means Austin, and anything along that 35 corridor. We do like DFW, even though it's a pretty competitive market, so is Austin. We like Atlanta, and we like Florida, right? And we don't like Miami as an investment, even though some people are trying to talk me into it this weekend. I like Tampa, I like Orlando, and I like Jacksonville.
We should buy a deal in Miami.
He likes Miami.
So we can go visit Miami.
No, I mean, it gives you an excuse to go to somewhere cool, right? But, and we do, like we talked about earlier, I like Phoenix. We just haven't explored those markets as much as we probably should, and we haven't developed those relationships, right? But Arizona's a great place. So are the Carolinas. But our core markets are going to be Texas, Georgia, and Florida, right? And the reason being is population job growth, landlord-friendly, tax-friendly. 4 metrics that we look at. And in a lot of those ways, and Tampa and Jacksonville, Orlando, and Atlanta are all very, very similar in those respects to Texas, right? And no offense to people that live in the Northeast or live in California, but I'm sorry, there's more people moving out of those areas into the Sun Belt states than there are people moving out there, right? And there's a reason why, right? And it's because it's not business friendly. There's a high level of regulation and taxes, and that hurts investments.
I totally agree. But before we keep going, Money Mondays, we do this every Monday, 3:30 Central. Usually we sit, talk about a presentation, drink some coffee or two, and then kind of do open Q&A. And so if you have ideas for future topics, definitely leave a comment, let us know. We're happy to watch them. And on today's show, we were talking about choosing your market, things to look for in a market. So that's kind of the topic for today. If you do have any comments, questions, go ahead and leave them. We're about to shift to the Q&A. And let's see. So chat says, hey guys, it was great to see you this weekend. Great seeing you as well.
Chat.
Didn't expect you guys to be in here to talk about commitment. Absolutely.
Oh, come on.
Yeah, we party hard and
no,
back at it. My voice is a little bit gone. I'm letting Ben do all the talking
yesterday
now.
Yesterday mine was totally trash. I woke up with my voice back, but no, Chad, I mean, we want to keep adding value, and we appreciate you coming out. Chad has a great women's group.
Yeah, that's true.
Huge following.
Great women's group. She was a speaker at the event as well.
She crushed it.
So I heard from multiple people that was actually their favorite, one of their favorite panels.
No, and it had the biggest buzz going in, and it definitely delivered. So we appreciate Chad and your support too.
So let's see. So Chris Collins says, "Oh snap! You guys just finished a conference and still doing a live, crazy dedicated."
Come on, man.
Hey, man, that was a long time ago. That was like 48 hours ago. Not even 40 hours ago we ended that thing.
Come on. Coffee helps, right? But the world moves on. We came into the office. I've only got 236 emails to go through.
I totally agree. So Kathy Libby says, "Good to see you guys here since I couldn't see you in Houston. Hope to be at your next event. Hope to see you there." For those of you that didn't hear it earlier, it's going to be, we're aiming for July in Florida.
In Florida.
All right. So
where in Florida is TBD, but follow us here on Disrupt Equity's Facebook page or one of our pages on social media or on the MFIN Facebook page. Yeah. And we'll be making some announcements.
That's all right. So let's keep going. So Chris Collins, good question, says, thoughts on Tyler, Longview, and Killeen. Tertiary markets for buying one's own deals.
I am going to tell you one market that I do not want you to be in.
Killeen.
Killeen.
I can read his mind.
Do not be in Killeen, all right? There's a reason why they're still trading at 8,
or
9
be in
caps.
Killeen, but understand the risk-adjusted part.
Yeah, that's fine. Okay, so yeah, if you can pick it up for a song, I get it. But unfortunately, they're still being priced fairly aggressively. Because people want to buy multifamily.
But why should a person not want to be in Killeen, Ben? And again, if you're in Killeen, no problem with it too. But it's just for someone that gets lured by the price, needs to just kind of realize also the other side of it, right? The risk
And I've almost fallen into this trap multiple times on Killeen, where I'm like, dang, this is a great deal. It really spits off cash flow. The problem is that it's a military town. Everything revolves around Fort Hood, right? Which is one of the biggest military bases in the country, and I don't ever see it being shut down. The problem is, if we go into another war, you can have half your tenants, or maybe even 3/4 of your tenants, say overnight, hey, I got orders. They can bring their orders in. They can get out of their lease. There's nothing you could do. You can't charge them anything additional. That's how this works, right? And we've seen some people lose their shirt in Killeen. Another one that I would shy away from would be Oklahoma. But once again, we've seen some people be successful, but the majority of consensus is people are not successful in Oklahoma. Tyler, Longview, we've seen some deals come out of there recently. We know some people that actually buy in there.
I did a little mini vacation at Tyler a couple of months ago.
You went to there's like a water park.
A little small water, indoor water. We were looking for indoor water park. There's like 3 in the state. That was one of them. And I was like, hey, it's an excuse to go check out a new city.
What'd you think?
It was smaller than I expected, maybe.
It's definitely a small town.
But some parts of it is pretty developed, I guess, right? So I guess maybe that's what it is. Maybe there was more of a spread in the discrepancy of the city than other places. Meaning, you go to Houston, everything is kind of various levels of the same thing.
Yeah.
Whereas over there, there's parts that really old, really country. There's parts that are a lot more modern. So it's that's what I mean.
Yeah.
So that was maybe, and again, and there's nothing wrong with it. It's just wasn't what I was expecting. So overall, nice, quaint little town. I think it's growing, and so I think there's some opportunities there.
Yeah, we know a couple people that own in Longview too, and we've looked at some deals there too. Let's say those are TBD. I don't know enough about those, Chris. I do know Killeen, and I'd say don't go after it, bro.
Okay. Let's keep going then. So chat says, are those tertiary markets? Yes, they are.
Mm-hmm.
All right.
Yes, those would be considered tertiary.
Yeah, so if anyone has any more comments, questions, go ahead and leave them. We're in the Q&A section of the show, so we're happy to kind of talk through
and maybe
things
we talk about secondary and tertiary, right?
What is a secondary market then?
Yeah, I mean, it's smaller than a primary, right? So here in Texas, what would be considered a secondary would be like a Corpus, a Waco, a Lubbock, a Beaumont, those types of places, right? Whereas a tertiary would be like a Longview or a Killeen. Those are smaller than the secondary markets, right? And we actually like secondary markets, right? As long as they've got some economic drivers behind them. And we've done very, very well in Beaumont. We've looked at deals in Corpus. We actually like Corpus. You just, once again, you need to understand that it's a smaller market, and because it's a smaller market, there's going to be some inherent risk there, right? Because it's not as diversified of an economy as, say, a Houston would be. So, that's one thing to kind of think about. Yeah, what else we got, man?
So who else has comments, questions? So Chris says, okay, thanks, guys. One goal is to buy my own stuff versus a larger syndication. So looking at markets that can still work. Yeah, and I think ultimately, Chris, it just goes back to the age-old thing is in the secondary, tertiary market, you're going to have to figure out how to manage it, right?
Yeah,
There's going to be just less management companies willing to do it. If you're looking to do your own, it might be smaller. So now you're in a place where there's less people that will do it and a smaller asset, which is less attractive to people too.
Yeah,
so
you're not de-risking that. You're not de-risking that investment, right?
Ultimately, I would if you're trying to get your own, Chris, one thing to think about is maybe not do a syndication, but do a small JV, right?
Yeah.
You and 3 other guys, so at least you can buy something big enough, or maybe in the right market that makes sense. That's kind of that's what I would do, and that's kind of what I would say.
About. It goes back to if you have 50 units in Houston, you can probably you could probably find somebody to manage that, right? Yeah. But 50 units in Killeen, that's gonna be a stretch, right? So no, I totally get it, man. That's a lot of people we're seeing trying to kind of go down that path.
Yeah, and Chris says the other fear is who to sell to. Absolutely, that's a good point
that's
too.
The problem, right? You get caught up in these 7, 8, 9 caps, and you're thinking, man, that's a great deal. But there's a reason why it's a 7, 8, or 9 cap. It's because it's in Killeen, right? And that's what you're going to ultimately sell it for in the future, right? So your exit's not going to be as strong. right? But I'm not even as worried about that, right? Because we're cash flow investors anyway. It's more so that the fear that you're completely beholden to that Fort Hood base, right? And what happens there?
Yeah, and again, it depends on your goal. If your goal is, hey, you just want an asset for 40 years, then you probably don't really care about who you sell it to or some of these other things, right? You're just gonna hold on to it and then make an exit whenever it makes sense for the market.
Yeah.
Okay. Right. For us, we've kind of shifted. We've done secondary markets. We're focusing more on primary, just because you can go full cycle more quickly and more easily, et cetera.
Yeah, there's more buyers. Right, which was another thing that came up this week, right, or this weekend, which is, kind of, buying deals to, and looking at what is the exit strategy and who is your buyer pool after the fact, right? And you should always look at that, right? Yeah. Think of what's your avatar person that's going to buy this deal in 5 to 7 years if that's your exit strategy. Yeah. And if you're thinking, man, there's not a lot of people that are going to buy that deal 5 to 7 years, then it might be a reason why, right? Because it maybe ain't as attractive as you want it to be right now. So something to keep in mind, right?
Absolutely.
Any more questions, man? Where's Ronnie at? Ronnie's not on here?
People have questions, comments, go ahead and leave them. We will.
He better not be on Clubhouse. I know that guy.
Let's see.
He has 20,000 followers on Clubhouse, man.
Yeah, so let's see. Nasser says, what are your thoughts on student housing? It's a thing, right? You got to know how to operate it. It's, it sounds great on paper sometimes, but then you dig in a little bit more. You just got to know how to operate. Right. Yeah. I mean, ultimately, all those units, I think something like 80% of the leases in student housing happen within a 2-3 month window.
Yeah. If you miss that window,
you got to turn all the units and get them all leased up in that 2-3 months, and so
there's a risk there, right? So you need to know when you're going to buy those deals too, and where are you at in that leg, right? Because if say you buy in January and you're gonna update and turn units and lease it up because it's currently at 80%, realize that it's going to be 80% until the summer, because they're not going to sign new leases in the middle of the year. Right, so or middle of the school year, that is.
I agree.
Because what's going to happen is mommy and daddy are going to come in, sign the lease for the whole year, in that kind of June, July, August, time frame, and after that you're SOL. So, but once again,
and Ben, for those in the audience, what does SOL mean? No,
come on, this is a PG show. All right, I dropped the HD or HE double hockey sticks before, and somebody got onto me.
Not a problem.
So what else we got, man? Any other questions?
What else? Who else has comments, questions? We are here for you. So it said, chat said, thinking of more than one exit strategy would be good. Also, Kathy says, how do you like San Antonio? We like San Antonio.
We do. It's an operator's market.
It's an operator's market.
You're not going to get the appreciation that people in DFW are getting, that people in Austin are getting.
But it's starting to get expensive now, so maybe we are starting to see some of that here.
Yeah.
You don't get the rent growth that the other guys are seeing.
That's
maybe the better way to put it.
That's probably the better way to explain that, right?
You're not getting the crazy rent growth that you do get in like a DFW, right? Yeah. But it's starting to get kind of expensive. So
everything's starting to get expensive. And that's something that we were talking about this weekend, folks. There is a ton of demand, and there is a ton of money in the market. And so you have to realize that it is going to be a competitive situation on almost every single deal.
So Chris says, basically, thanks for the insight. Any markets around Dallas that you think are still viable? Yeah, I mean, we like the DFW markets. I think Fort Worth is still, there's still a little bit love to be had in Fort Worth.
It depends on which side. There's one side you don't want to be. I forgot which one. It was either the east or the west side.
The west side is what you're talking about, right? But I mean, even then, opportunities.
There's like a ranch trail road or something that's supposed to be the hood. You want to stay away from that. But no. DFW, anything that's in the Metroplex, man, it's going to be competitive.
Yeah.
Because there's a lot of people there that are looking for deals too.
And I think Denton is another sub-market kind of DFW. You could probably double down, and that's far enough away. Maybe there's less competition. You can probably pick up some deals, right? As it grows. I'd say Fort Worth West Side is a side that usually don't want to be on. Dallas far south side.
Yeah, the south side of Dallas.
But again, there's opportunities there, and if you dig in and get to know those markets, you might be able to make a better informed decision than us, right? Yeah. We're playing generality.
There's a ton of other markets, man. DFW. Every time we go up there, we're amazed. It's growing. I mean, so is Houston. But the Metroplex, for everybody just so you understand, right, it's Dallas and Fort Worth, right? And it's kind of merged together as one big blob of a Metroplex versus Houston.
Yeah, right? But ultimately, it was kind of verified that Houston is the better city in Texas, but, DFW is a good place to invest as well. So.
There we go. We did not say that with any bias whatsoever. All right, so
We got another question really quick before we wrap up. Last question. What's your primary motivator for deciding when to disposition a property? Ultimately, it's about, we like to say we are opportunistic investors. This is not a meetup, Ben.
No, I'm sorry.
We're opportunistic investors, right? If it makes sense, we don't have to stick to the business plan, right? You can tell investors, hey, let's take a vote, let's make an exit sooner, right? It's ultimately about what makes sense for that deal. There's not a one-size-fits-all mentality, right? If you're sitting on, like, there's situations you might be sitting on a ton of equity, not as much cash flow, right? Like we said, actually, a good example, San Antonio, where you might have some of the equity because values have dropped, but the rent growth hasn't been as correspondent, and so now we'll maybe make an exit, right? Or you might have deals that are just cash flowing, really simple deals, and you're like, you know what? Maybe we'll just do a refi and hold on to the deal longer, right? So it's really about thinking through your deal, your situation. But ultimately, it's balancing where's the deal, right? And I like to say it takes 6 months to get to know a deal. It really does, right? So once you're kind of in the deal, it's about, okay, what's going on in the deal, right? It's presumably not going to change drastically between today and 3 months from now, right? So once you're in it, you kind of know, and understanding where you are, where cash flow is, where your debt is, right? And being able to kind of go out there and make what you need to happen to get your returns.
You just have to look at the market constantly, and don't feel like you have to understand that or have a crystal ball, because the brokers are going to be breathing down your neck to sell your deal anyway after about a year or two. So they'll tell you where things are trading, and then you ultimately can do some back of the napkin analysis and figure out, does it make sense, right? I'm a big proponent of, if you can sell now, take money off the table and roll that into the next deal, that's always a good thing, right? But there's some deals that we like and are clean and we're just going to hold on to for a little while, right? So just dependent on the market, really. But hey, we got our toolkit. So all this content that we like to pump out, right? All of our checklists, all of our webinar replays, all the podcasts that me and Ferris are on, we all bundle this into the toolkit. So check us out, www.disruptequity.com/toolkit. We're not selling you anything. It's just all right there. Make it all clean and packaged up for you. So what are we talking about next week? What are we talking about? Oh, financing. One of the more important things, you got to have your equity, raising money, and you have to have your debt, right? So what do you need to know about how the capital stack works, how putting debt together, how getting a loan on these properties works, right? So that's an important part of the process.
Absolutely.
All right.
So look forward to seeing you all there. We're already at time, so we'll go ahead and call it a wrap. So Monday, Mondays, we do this every Monday, 3:30 Central. If you have any comments, questions, let us know. If you have any ideas for future topics, let us know. Otherwise, we'll see you all next week and talk about multifamily financing.
Next Monday. Thank you.
Thank you all.